Hello everyone, welcome to Biz Elements. Today we're going to be talking about the importance of financial planning. It is very important that we have a comprehensive financial plan as part of our overall business strategy. What it does is allows us to be able to monitor at all times exactly how we're doing financially. That is a critical aspect of our business to ensure success, sustainability, and allow us to be able to grow. How are you, Hasnain?
Hey, Mohammed, I'm all right. How are you?
Yes, very well, thank you.
So, financial planning.
Yes.
Serious topic.
Yes, very much so. An integral part of the business, really.
So, you mentioned in the introduction that's really important. How do we get started?
Well, basically, I think the important factor here is to set clear financial goals for your new business and then follow it through quite specifically with measurable, attainable, and relevant, time-bound SMART goals, okay? That's going to be important.
That's great, Mohammed. But shouldn't we be setting some sort of targets?
Absolutely. Our financial goals have to be related to revenue, profitability, cash flow, return on investment, and all the other relevant metrics. That's really important.
Right, I get it now. What's next?
So the next stage is to actually start to estimate our startup costs, which is very important. So in that category, we have one-time costs, so things like licenses, equipment, everything that you have to be able to start up a business. And that's a one-time cost. And then the second is ongoing costs. So things like salaries, rental, anything that has to be paid to maintain the ongoing business. After which, we actually have to ensure that all our potential expenses are an accurate estimation. But what I would also recommend strongly to our listeners is please try and see if you can make a section where you can actually estimate any other possible expenses that may occur.
So have a contingency fund.
Yeah, if you have a contingency fund or, the favorite line in the accounting called miscellaneous, have a fund there just in case. I mean, I would probably say if you're investing $100,000, keep $10,000 in your contingency plan just in case.
Interesting. So a 10% contingency fund.
Correct.
That's a great tip.
It is, because you don't get caught by unpleasant surprises, right?
So we talked about estimating startup costs. What would be next? Is it budgeting and expense management, sales? I mean, what are we looking at?
Okay, so we need to create a sales forecast now. And that will be based on some of the information that we already have, because we've thought about our USPs. Everything is done now, right? So we're now ready to really talk about sales, get to the nitty-gritty.
I guess the business model here would play an important role.
It is. The business model is very important. We need to forecast our sales. We've done our market research. We've done and understood our industry benchmarks. So that all comes into it. The whole thing comes into it. The significance of market trends, competition, and also potential growth opportunities is important when we're developing a sales forecast.
So what you're saying is based on how much money your competitor is making or how much money there is in the market, you can develop your forecast by saying, I can take 10% of the market share, or 20% or 30%. Is that right?
I think that's a good yardage. I wouldn't say that's the best way of doing it, only on the basis that sometimes you need to understand what you have, what your current resources are, for you to be able to forecast sales.
But shouldn't you have a target to say, I want to gain 10% market share, I want to gain X, Y, and Z?
I think if your market research and your analysis is strong, then yes, you could do that.
Right.
But I don't want you to get the feeling that you could do that without the historical data at hand.
No, but
that's important.
No, but that's already been done earlier, right? So we spoke about market analysis, in the previous episode.
Correct.
So the assumption here is that the new entrepreneur has done all that research so that at this stage they don't
Right.
have to go back to the drawing board to get that information.
Okay, if there's no gaps and he's done the research and there's no gaps in the research, then absolutely. You have to forecast. That's what a forecast is, right? So you can decide whether it's 10% or 15%, whatever you feel is good for that marketplace. But what I do want to also emphasize is once we've done a sales forecast, ensure that it's flexible enough to be able to pivot and change to meet the marketing trends when the business starts.
So essentially what you're saying is make sure it's not a static document and conduct periodic reviews.
Absolutely. And that I can't tell you what periods because you need to define that yourself when the business starts.
Yeah, that would be based on actual performance.
Yes, I mean, if a business does a high revenue, I would suggest you look at it monthly.
Yeah, and make it more aggressive.
Absolutely.
But obviously, if the sales are slow, then you take it easy and you maybe look back and you see, okay, how can you improve the sales? Because it might be a flaw in your marketing.
Absolutely. And there's many factors when sales is down that you need to consider.
All right. Great. So we talked about creating a sales forecast. What's next?
Our next topic is budget and expense management. That's really important. Now, you must have a budget because that way it helps you to monitor and have a guide for you as far as expenses are concerned. Now, you need to ensure that you allocate funds to different business functions such as marketing, operations, everything that you want to spend money on. So you need to have that clearly and concisely recorded. We need to set achievable budget targets, not hairy-fairy figures, okay? The importance of monitoring expenses and to be able to have cost-saving strategies such as negotiating vendor contracts to try and get more discount, off what you've already got, or, even menial things like, oh, when you ship to us, I'll have free shipping. Shipping is very expensive. So those are excellent cost-saving tactics. And this will allow us to be able to also go to the next stage where we can have software for budgeting and we can have certain apps that help us actually monitor these costs.
So in summary, what you're saying is that because we're a startup, limited funds, we need to keep an eye on the money, both incoming and outgoing.
And Hussein, absolutely right. But I want to stress something to you. A lot of business people, they think profit is actually made in sales. It isn't,
Really?
Yeah, because the bulk or the cream of the profit is when you're doing purchasing. Just imagine saving 5% or 10% on purchasing. How much profit does that add to your bottom line?
And that's interesting. Does that also flow through for a service business or only bricks and mortar?
No, even service. You just need to ensure that you make profit at every cost center. Just selling and making a profit is not about making profit. Save on purchasing as well, because you could actually make a tidy bundle.
What's next, Mohammed?
Next is financial projections and cash flow management. That is quite an integral part of your financial business, okay? Unless we have good stats on what cash flow we have and what kind of money we have, the business is going to fail. So I don't want to use scaremongering tactics here, but unfortunately I would have to. So the financial aspect is very important. You've got to keep an eye on, make sure you have your profit and loss balance sheets, cash flow management budgets, everything in place. And then you've got to watch your receivables and payables. Now remember, that's important. If your payables are much higher than your receivables, you need to keep a very close eye. Now, you can have that only temporarily from time to time. But really, obviously, it's much better to have higher receivables and payables. But keep an eye on that because that forms part of the complete overall health of the business from a monetary perspective.
So, Mohammed, I understand that you're a startup and you don't have much money, but would you need an accountant, a certified accountant?
Well, before I talk to you about having a CPA, I think the important factor is that you should have one anyway. When you start your business, it's always good to have a CPA in the corner. And now that you've mentioned CPA, I have to touch on the legal aspect and say that you should really have an attorney as well. Those two aspects of the business are very important. The one other thing that I want to talk about and touch upon is that we will be having a full financial topic later on in our startup series. What I do want to end with is to be able to explain what kind of funding we can get for our business, okay? Now, we can self-fund this. We can have our friends or family help us. We can get bank loans. There is also angel investors around that can possibly look at investing in your business, or even look at venture capital or crowdfunding. But remember, the three that I mentioned will want to take some stake in the business.
You mean the last three?
Right.
Right. Okay.
So, the angel investors, venture capital, and crowdfunding, they will want equity of the company. So you need to be aware of that. It's not going to be just interest. Yeah?
So we've spoken about financial projections and cash flow management. I'm thinking there's something missing here.
Yeah. I mean, we need to make an allowance for risk management and contingency planning.
Of course.
That's going to be quite an important aspect as well. And to a certain extent, it's kind of tied up with the last section that we discussed. But here, the important factor is that I want to ensure that the small business owner understands that we have to do some risk management. I know this is probably the echelon of the corporate marketplace, but I think it's important that we understand what we need to do. So, some of the risks that can really affect small businesses are things like natural disasters. So, living in Florida, we've had a few of disasters and we've had enough of our share.
You're talking about the floods and tornadoes.
Correct. It's been quite bad. Now, the thing is, small businesses were affected because they hadn't done any kind of risk management and there was no planning. So the important factor is allow for that as well. Make sure that you've got budgets for that. Make sure that, you're able to have business continuity afterwards.
So what we mentioned a little earlier in the episode about having a contingency fund, this is where it comes to play.
It does to a certain extent, but I would rather us keep that separately because that was for other factors, other expenses. This one, I think we should have a special risk management budget.
Oh, right.
Yeah,
so those are two separate...
Yes, very much so. And the reason is very simple. Look, you need to have insurance for the business, okay? So that needs to cover it as well.
So what insurance would I need? Give me an example.
The example is very simple. When you go to the insurance broker, you ask for risk management. You say to them anything that has, anything that whatever risk that we have, natural disasters or even in-house. Now remember, unfortunately, you can have disasters within the business organization where a staff maybe steal something or break something,
right. or fire.
Exactly. So don't forget, it's not just natural causes. So that's what they need to allow for with an insurance broker.
Right. And I guess this would then segue into having contingency plans for if something does happen.
Correct.
So you might get compensated from the insurance broker, but what happens in the meantime to your operations if there's a fire that's broken out?
So let me give you an example, okay? This is very important for the small business person. Every business, no matter what size you are, you're going to have data, correct?
Yes.
You'll be saving on a hard drive or a server or on NAS. It doesn't matter where you're saving it. What happens if that's damaged and the data is lost? What you've done is you've actually lost the single largest asset of your business. You've lost all the customer records, all the transactions, everything. So, somehow you've got to mitigate that risk. So we will talk about that at a later time. because we have other series that we talk about how to recover from disaster recovery. But the important factor here is you need to have it in the plan.
Sounds good. I guess it's time for conclusions and key takeaways.
So I can't emphasize enough of the importance of building a comprehensive financial plan for your new business. So it's important, have budgets, everything in place, contingency plans for possibilities of disasters, risk management, have everything in place. That's really important.
And I guess I know it's mundane, but it's also important to make sure you set your financial goals, your revenue targets, your cost targets, and so on and so forth. Because without that, you can't monitor anything. And we all know what doesn't get monitored doesn't get addressed.
Correct. And the important factor is to have a solid financial plan. It serves as a tool, a valuable tool for us, and as a guidance as well, for us to go in the direction we need to. And we can't make any informed decisions. How do you make decisions without a proper and solid financial plan? I can never envisage doing that.
You can't. I mean, it's not possible.
And if we fail to do that, I think we risk the long-term financial success of our business. So this is an important factor. Please, take it seriously and make sure you do this, because the old yardage, if you don't plan, then you plan to fail.
Mohammed, as always, it's been a pleasure.
Absolutely. And thank you, listeners, for joining us today, and we will see you next time.